My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. It's my job, not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I've spent the last 24 hours trying to get my head around why so many people lost so much money on just a handful of high-profile stocks. And I keep coming back to the idea that this is a force majeure situation, more or less an act of God that hardly anybody could see coming. But we need to survey the damage tonight on our last show of an amazingly bad stock market year. Even today was pretty decent. Dow gaining 176 points. How about that, huh? S&P rising 0.59%, NASDAQ hitching 0.21%. Maybe Santa is visiting. First, let's define the list of stocks I'm talking about. There were plenty of big cap stocks that got killed this year. So we'll limit the discussion to companies that were valued at more than $750 billion at some point in the last 18 months. Get a load of these peak to trough situations, okay? Tesla, let's start with that. It has fallen 70% from its peak, losing $846 billion in market capitalization. And then there's Meta Platforms, formerly, Facebook. It tumbled more than 69%, losing $770 billion. NVIDIA has shed 56%, or $425 billion. Amazon sunk 55% from its peak, or almost $1 trillion. Alphabet dropped 41%, $798 billion. Microsoft is down 32%, which is $772 billion. And Apple has dropped 28%, a lot of money, $851 billion, but better than the others. That is a total. This right here is a total of $5.4 trillion in lost value, okay? $5.4 trillion. Just an incredible amount of lost money, the likes of which actually I've never seen before. And chances are pretty good you lost money in at least one of these stocks. We certainly had some round trips here for the Charitable Trust, but in retrospect, we were lucky to unload many of these at much higher levels. Why? Because we have rules. They simply became too big a portion of our fund, and discipline says you must trim when that happens, so we followed our discipline. These are the stocks where the most damage was done this year, and I wouldn't be surprised if they're still going to cause problems for next year, unless they get their act together, because there are fundamental problems here. Now, if you're like my Charitable Trust, you've held many of these for a long time. In that case, technically, you might not have losses, but you certainly missed a chance to sell your entire position at much higher levels like we did. Your gains are much smaller than they could have been. That's why I always tell you to buy and do homework, not buy and hold, like the Graybirds say. Why? Because buy and hold totally failed you here, with the possible exception of Apple, which fell a lot less than the others. And by the way, I think of all these, has a much better chance of revisiting its old highs, even as I expect that Apple at the beginning of the year is going to have to give us an update that's going to be very sobering. But let me give you the reasons I can't blame anyone for what went wrong here. And no, it's not just because I didn't take all the gains when I had them for my Charitable Trust. It's more complicated than that. First, these 7 stocks were all major components of the S&P 500. So if people chose diversification, if they took a responsible approach to managing their money, then by definition, they had some exposure. If you own an S&P index, 500 index fund, you put money in an index fund, that's diversified, supposed to be safe, right? They're responsible for a huge chunk of the losses, though. These 7 big cap stocks peaked at various times in 2021 and 2022 at moments when people were contributing the most to their index funds, which meant each of these stocks got bid up too high. In short, part of this is because they were artificially elevated by the aggressive index fund buying. Can't blame anyone for that, but I will. But I am sick and tired of hearing people tell me that the index funds are the only way to go, because the index funds really crush you because of these. Second, it's not like the people running these companies ever said, you know what, my stock is too expensive. It requires lots of things to go right in order to maintain these levels. Maybe they believe their stocks deserve their valuations. Others simply make a policy of never commenting on their stock price because they say it's your decision, not theirs. I like that. I also like that Elon Musk said he might be done selling Tesla because his own selling slaughtered the stock. But then again, with the new electric vehicle competition coming from Ford, GM, BMW, Tesla's still too rich for me. These guys have never faced any major rivals before, and now competitors will always hurt your margins, but it's a good company. All that said, there's nothing wrong with admitting that your stock is too high. So let me give you an anecdote that puts it in perspective. When TheStreet.com, which I founded in 1995, came public in 1999, it was a very hot market right then, kind of like 2021, okay? Came in 1999. It opened at some absurd level in the 60s, priced at 19, giving the company a valuation of more than $1 billion. This company is losing fortunes, and it valued my stake at $350 million. So what did I do? I called out the buyers and said, stop it. I said it was ludicrous. I said they were paying so much. I told my father and my sister to sell her. I told everybody that I said that to them. I urged people not to buy it because I didn't want to lose anybody money. And I knew the stock was a losing proposition up there. Sure enough, like so many of the last year's IPOs, the street didn't bottom until it sank to $2, at which point it was selling for less than its cash position, making a mockery of buy and hold. And that's what's happened to a lot of the joke 600 stocks that come public the last 2 years. Third problem, the love affair with tech knew no bounds. At the highs, tech, media, and telco added up to 34% of the S&P 500. All sorts of ETFs were created to capture segments of tech, which funneled more money into these mega cap stocks. They were bogusly diversified. Fourth, the Federal Reserve played a role here, too. Not a good one. I'd argue that they were just doing their job. But on the way up, the Fed propped up tech valuations with basically free money. Then when it tightened, the free money went away and all these stocks got crushed. That's still happening. It's quite dispiriting. It's not going away. But it feels disingenuous to blame the Fed like so many people do. Jay Powell never told you to buy Meta or Tesla and never told you to get out of NVIDIA. It was not his job. At the same time, Wall Street stoked the fire here with endless reiterations of buy ratings and price target bumps. Of course, they threw in some SPACs to make you really lose money. To be fair, the industry's always like this, though. They like hot merchandise. Most importantly, though, the companies themselves turned out to be unworthy of their valuations. Amazon can only grow to its $1.8 trillion valuation at the peak because its numbers were inflated by COVID. They still haven't gotten rid of the bloat there, which is why the last quarter was just so awful. Meta got way too high on advertising. That vanished when things got tougher because Apple made it harder to track online behavior on their devices, making targeted ads less valuable. Apple cared about your privacy. Doesn't help that they're sinking billions into the metaverse without showing much in the way of results. Even when Mark Zuckerberg announced other cost cuts, he refused to touch that metaverse spending. They have to figure out a way to get people to post more, too. Tesla was printing money when it had no competition, but that's no longer the case. NVIDIA had the best semiconductors in the world before the industry nosedived. Remember, we also said to China you couldn't have some of their best. Microsoft benefited from strong software sales and also strengthened the cloud infrastructure business, both of which are now slowing. Alphabet's ad-supported in a world where advertising is falling apart. Apple couldn't make enough product to meet demand because of its issues with the Chinese suppliers. Compared to the rest, it's actually a high-quality problem, but a problem nonetheless. Finally, I think the mega cap stocks were the ones people wanted because they love their products. So many people own an iPhone, everybody uses Google, and what could be cooler than owning a Tesla? But that's rarely a good reason to own anything. It's a good reason to start, to look at something. Now, if we see these stocks creeping back from their old levels all the way up here, then you know what? Let's remember that prices do matter. And we don't want to get burned the next time they go too high and pull that Icarus act. Right now, we want cheap stocks of companies that make things or do stuff at a profit and return some of those profits to shareholders. Unfortunately, most of these big tech companies simply don't fit the bill. But here's the bottom line. Because Tesla, Meta, NVIDIA, Amazon, Alphabet, Microsoft, and Apple are all major components of the S&P 500, they'll be able to bounce the next time we get a nice rally in the Border Index. And I think we're going to have one. I think you should use that chance to pare back on mega cap tech. Not get rid of them, but pare back. I bet you'll get a chance to buy them a little lower. I want to take calls. I want to go to Jim in Virginia. Jim.
Shivering. Oh, booyah, Jim. How you doing?
I am doing well. How about you, Jim? What's going on?
Hey, brother, I got my thermals on today, no doubt.
All right.
Hey, to fund my retirement IRA, I have all the name brand mutual funds that I feel comfortable with, but I also purchased stock GNRC at 230.
Generac.
It did really well. but now I'm feeling about as cold about it as it is outside.
Well, Jim, what's happened is a new sheriff in town, the Ford F-150, is going to be able to power your house in an outage just like the Generac. So I think people feel like if I got that truck, the best-selling truck in America, yeah, I don't need a Generac. And I feel I feel the same way, and that's why I'm thinking about getting one myself. All right, let's go to Parker in Maryland. Parker!
Hey, shout out to Mr. Marx's class, booyah to you, and I just wanted to know about PayPal.
PayPal has a lot of competition, and we lost a lot of money in PayPal for the charitable trust, and believe it or not, we sold it at a much, much higher level. I still can't count on us buying it. There's too much competition. But these mega cap tech stocks will be able to bounce the next time we get a broader index rally, and I think you might want to use that to pare back on your positions. I bet you, if you really want to, you can get a chance to buy them lower. Well, maybe tonight, the consumer discretionary sector was the second worst performer in 2022. So what can this year's performance tell us about what's going to happen in 2023? I'll give you my take. And Santa Claus, rally or not, does your portfolio have what it takes to handle whatever this market throws at it? We're playing MI Diversified to see if your portfolio passes the test. And the communication services sector, oh man, did that struggle. And I'm setting you up for next year with two big ideas I think you should be watching. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.